Are you looking for a way to get involved in the cryptocurrency market without having to buy and manage the actual coins? Cryptocurrency ETFs offer a great solution for investing in the digital currency market without the hassle of owning the coins. In this video, we will discuss the benefits of cryptocurrency ETFs, including their ease of access, diversification, and tax efficiency. So, if you're interested in learning more about the advantages of investing in cryptocurrency ETFs, keep watching. Hello, welcome to our channel. Please subscribe to our channel if you haven't done so yet. Due to their intraday liquidity and cheap transaction costs, ETFs have been popular as an investment vehicle since the mid-1990s. Traded on stock markets, ETFs typically mirror the performance of an underlying index. How do exchange-traded funds work with cryptocurrencies? A cryptocurrency ETF is a mutual fund that invests exclusively in digital currencies. In contrast to the majority of ETFs, which follow an index or a basket of assets, cryptocurrency ETFs follow the value of a specific digital token or token. Share prices of cryptocurrency ETFs change daily due to investor buying and selling. They are exchanged on a daily basis, much like regular stocks. What is the function of an exchange-traded cryptocurrency fund? In contrast to traditional ETFs, which hold the underlying asset outright, crypto ETFs own derivatives such as cryptocurrency futures, options, and other crypto-based instruments. The goal is to produce a pricing pattern that is similar to that of the underlying cryptocurrency. However, because ETFs don't actually own any of the underlying cryptocurrencies, there may be times when their price movements diverge slightly from the underlying price of the cryptocurrency. Exchange-traded funds that invest in cryptocurrencies are backed by either actual crypto properties or synthetic counterparts like derivatives. Crypto investors can indirectly hold cryptocurrencies through the former without the costs associated with direct ownership, while the ETF share price mimics the price movements of derivatives rather than the prices of actual cryptocurrencies. And so, why do crypto exchange-traded funds matter? Bitcoin and Ether ETF investors, for example, can gain exposure to many cryptocurrencies outside of the traditional securities markets, which is the most obvious rationale. Benefits of ETF. The following may be of interest to crypto investors who have exchange-traded funds. Notwithstanding the regulatory ambiguities surrounding Bitcoin ETFs, exchange-traded funds like ProShares Bitcoin Strategy ETF allow investors to gain exposure to a volatile asset class at a reasonable cost. Because analysts handle the learning curve for you when you invest in Bitcoin ETFs, it's a great option for first-time traders. Those who invest in crypto ETFs can avoid paying the likes of custody fees, transaction fees, and network fees. Investors may rest easy knowing that their ETF provider has their back in the event of a phishing scam, cryptojacking, or cryptocurrency theft. The infrastructure for buying and selling cryptocurrencies is still in its early stages. Some tokens, for instance, are only available on certain cryptocurrency exchanges. However, cryptocurrency ETFs allow investors to expand their portfolios without incurring the cost of purchasing individual coins. How secure is a cryptocurrency ETF? To begin, we'll address the following concerns. Are cryptocurrency ETFs regulated? Are ETFs suitable for novice investors? Before we can determine if crypto ETFs are secure, to stop people from misusing the market or using it to fund illegal activities, all parties who invest in cryptocurrency ETFs must be authenticated and their trades are tracked. However, because crypto ETFs are issued by regulated firms and sold on established, regulated exchanges, investors may put their money in them with greater peace of mind. Even though many people have asked the U.S. Securities and Exchange Commission to allow Bitcoin spot ETFs, they have yet to be set up. However, a select group of companies has given the Bitcoin Futures ETF their stamp of approval. The regulatory environment shouldn't change how you think about the danger of investment in cryptocurrency exchange-traded funds. For instance, whether you're just starting out with trading or are an experienced pro, you should know that your options for cryptocurrency ETFs are quite limited. Also, the funds that can be used only follow a small number of cryptocurrencies and are vulnerable to hacking and other forms of cybercrime. Also, because the cryptocurrency market is so volatile, it shouldn't be a surprise that investments in cryptocurrency exchange-traded funds can also see big price changes, especially if the funds are backed by real cryptocurrency. So, investors must weigh the pros and cons of different financial instruments to decide if their cryptocurrency investment is a good idea. What steps should you take to put money into an exchange-traded fund that invests in digital currencies? If you are not willing to manage your crypto investments but still want to expand your portfolio, a cryptocurrency ETF is a better option than purchasing digital assets directly. Below are the actions you should invest in blockchain-based ETFs. To open an account, you should go through the onboarding process at a broker like Fidelity, Robinhood, etc. Determine how much of your total budget you want to invest in ETFs. You should start by opening a brokerage account and searching for ETFs that interest you. Put BITO into the search field if you are inclined to buy shares of that exchange-traded fund. If you wish to acquire cryptocurrency ETFs, you should use a market order. Choose to buy by clicking the link. You can enter the maximum number of shares your budget will allow here. Make a plan with your broker if you want to keep growing your investing portfolio. Even though all of these things are easy to do, investors should be aware of the cost ratio or management fee that comes with buying ETFs. Expense ratios are annual fees charged to mutual fund and exchange-traded fund shareholders. How do exchange-traded funds generate income? Therefore, you should look at the expense ratio. Exchange-traded fund issuers mostly get their money back for operating costs through expense ratios and transaction fees. There is also the consideration of possible exits. Even holders, or long-term investors, will probably need to sell some of their holdings at some point in the future, which will result in yet another trading cost. That's it for today. Until the next video, goodbye and take care.